Two stories. Story 1. In 1977, a young portfolio manager takes over a small fund at Fidelity. Over the next 13 years, he turns $1,000 into $28,000. He retires at the top in 1990, having delivered 29% annual returns. His name was Peter Lynch. Story 2. In 2014, the UK's most celebrated fund manager launches his own firm. At peak, he manages over £10 billion for 300,000 investors. 5 years later, the fund collapses. Investors are trapped. They lose two-thirds of their money. He's banned from the industry. His name was Neil Woodford. Both of those funds were unit trusts. Same structure, same regulator categories, same selling pitch. Completely different outcomes. Today, I want to walk you through the two most common ways ordinary people invest in baskets of stocks, ETFs and unit trusts, what they actually are, how they're similar, how they're different, and then I'm going to show you 4 real case studies, 2 successes and 2 disasters, so you can see for yourself why the structure of an investment matters as much as the people running it. Let's start with the problem that both ETFs and unit trusts exist to solve. Imagine you want to invest in the stock market. You want diversification. You don't want to put all your money in 1 or 2 companies. The smart move is to own a basket of maybe 50, 100, 500 different companies. But here's the practical problem. Doing that on your own would cost a fortune in brokerage fees, take enormous research time, and require an account balance most beginners don't have. That's where pooled investment vehicles come in. The basic idea is centuries old, going all the way back to the 1700s in the Netherlands. You and a few thousand other investors pool your money together. A fund structure holds that money. The fund buys all the stocks. You own a slice of the entire basket. This is the foundation. ETFs and unit trusts are both ways of doing this. They're cousins, not opposites. But the cousin analogy matters because the structure of each one, how it's bought, how it's sold, how it's priced, how it's managed, creates very different outcomes for you as the investor. The differences are in the plumbing, and the plumbing is what matters when things go wrong. Let's define unit trusts first, since they're older, and ETFs are essentially a modern evolution of them. A unit trust, also called a mutual fund in the US, or just a fund in many countries, is a legal structure where a professional fund manager pools your money with other investors' money and actively makes decisions about what to buy and sell. The fund holds the underlying stocks or bonds. You hold units in the fund, which represent your proportional share. Here are the key mechanics that define a unit trust. 1. It's priced once a day. The fund calculates its net asset value, its NAV, at the end of each trading day, based on the closing prices of everything it holds. You buy or sell at that one price. You can't buy units midday at a different price. 2. You typically buy through a bank, a financial advisor, or an online fund platform, not through a stock exchange. Some platforms make this seamless now. Names like Endowus, FSM1, or your bank's wealth management arm, but historically, this involved paperwork and an advisor. 3. Most unit trusts are actively managed, meaning a portfolio manager and their research team are picking stocks, trying to beat the market. This is the whole point of the unit trust structure. You're paying for expertise. 4. That expertise costs money. In Singapore, typical equity unit trust fees range from 1.5% to 2.5% per year. Some go as high as 3.5%. There may also be entry fees, called sales charges or front-end loads, of 1.5% to 5% of your investment, plus possible exit fees, plus switching fees if you want to move to a different fund in the same family. The pitch of a unit trust is simple. Pay for active management, get above-market returns. The reality is more complicated, as we'll see. An ETF, exchange-traded fund, is structurally a fund just like a unit trust, but it lives on the stock exchange. That single difference cascades into a lot of practical changes. Here's what defines an ETF. 1. It trades on a stock exchange, like Singapore Exchange, NYSE, Nasdaq, Hong Kong Exchange. You buy and sell it through a normal brokerage account, the same way you'd buy any stock, throughout the trading day, at live, fluctuating market prices. 2. It's typically, though not always, passively managed. Most ETFs are designed to track an index. The S&P 500 ETF tracks the S&P 500. The STI ETF in Singapore tracks the Straits Times Index. There's no star manager picking stocks. There's a rules-based formula. This is what makes ETFs cheap to run. 3. Fees are dramatically lower. Most ETF expense ratios range from 0.05% to 0.5% per year. The largest S&P 500 ETF, SPY, charges less than 0.1%. There's no entry load, no exit load, just standard brokerage fees when you buy or sell. 4. You see the holdings every day. ETFs publish their underlying portfolio daily. You know exactly what you own. Unit trusts often disclose holdings monthly or quarterly, and sometimes only top 10 holdings. So when someone asks ETF or unit trust at a structural level, they're often asking, do I want active expensive management with end-of-day pricing, or passive cheap tracking with real-time trading? But that framing is too simple. Let's look at the similarities before we go further.
Here's what's the same about both.
Both are pooled investment vehicles. Both hold underlying securities on your behalf. Both give you diversification you couldn't easily get yourself. Both can be active or passive. Most unit trusts are active. Most ETFs are passive, but there are passive unit trusts and there are actively managed ETFs. ARK Innovation, which we'll discuss in a moment, is an actively managed ETF. The line is blurrier than people think. Both charge fees, just at different levels. Both have an expense ratio. Both eat into your returns over time. Both are regulated. ETFs by securities regulators because they trade on exchanges. Unit trusts by similar bodies. In Singapore, that's MAS. In the UK, the FCA. In Hong Kong, the SFC. The level of investor protection is broadly comparable, though the disclosure requirements differ. Both can hold the same underlying assets. An ETF can hold the same stocks as a unit trust does. The wrapper is different. The contents might be identical. Both can fail. Both can lose money. Both can have terrible managers. Both can be illiquid in stress. Both can disappoint expectations. Neither is automatically safer. That depends entirely on what's inside, not the wrapper. That last point matters a lot. The wrapper is not the protection. The contents are. Now the differences. I'll go through these in order of how much they actually affect you. Difference 1. Fees. This is the biggest in practical terms. A unit trust costs around 1.5% to 2.5% per year. An equivalent ETF often costs under 0.3%. Over 30 years of compounding, a 1.5% fee gap can consume 30% to 40% of your final wealth. This is the single most studied finding in personal finance literature. Difference 2. Liquidity. ETFs trade all day. You see prices live. You can exit any time the market is open. Unit trusts price once a day, and processing can take days. In a crisis, this matters enormously. In normal times, less so for long-term investors. Difference 3. Transparency. ETFs publish holdings daily. Unit trusts often don't. If you want to know exactly what you own, ETFs win. Difference 4. Active management. Unit trusts are usually actively managed. ETFs are usually not. Whether active management is worth paying for is the most fiercely debated question in investing, and the data overwhelmingly says, for most managers, no. Over 20-year periods, around 90% of actively managed funds underperform their benchmark index. The 10% that beat the index are mostly impossible to identify in advance. Difference 5. Minimum investment. Many unit trusts require $1,000 or more to start. ETFs can be bought for the price of one share, sometimes under $50. For small accounts, this matters. Difference 6. Distribution. Unit trusts are pushed by banks and advisors who earn commissions. ETFs are bought directly. This means unit trusts often have stronger marketing, and that marketing comes out of the fees you pay. Now the part that makes this video different. Real cases, not abstractions. Success story 1. SPY, the original ETF. In January 1993, State Street launched the SPDR S&P 500 ETF Trust, ticker SPY. The pitch was simple. Buy the S&P 500, get the entire US large-cap market in one trade, pay almost nothing in fees. At the time, this was revolutionary. Most investors had to buy expensive unit trusts to get diversified market exposure. SPY was the first US-listed ETF. Today, more than 30 years later, it holds over $670 billion in assets. It has paid investors steady returns, roughly matching the S&P 500 itself for 3 decades. Boring, effective, cheap, reliable. The lesson: structure beats brilliance. SPY has no star manager, no genius stock picker, just an algorithm tracking an index, and it has outperformed the vast majority of expert unit trusts over its lifetime. Success story 2. QQQ, concentrated bet, paid off. In March 1999, at the peak of the dot-com bubble, Invesco launched QQQ, the Nasdaq 100 ETF. Terrible timing, you'd think. Within 2 years, the Nasdaq lost 78% of its value. QQQ holders watched their investment crater. But here's what happened next. Investors who held on or kept buying eventually saw QQQ generate over 839% cumulative return from inception through 2024 versus 489% for the S&P 500. The fund now holds over $400 billion. Even with that catastrophic start, the long-term concentrated bet on tech innovation paid off enormously. The lesson: a tightly focused passive ETF can deliver extraordinary returns if the underlying theme plays out, but the path is brutal. Holders had to survive the dot-com crash, 2008, 2020, and 2022 to get there. Most people sold in the lows. The investors who got rich were the ones who didn't. Success story 3. Magellan and Peter Lynch, the legendary unit trust. Now the unit trust side. In 1977, a young Fidelity employee named Peter Lynch took over a small fund called Magellan. Over the next 13 years, he delivered annualized returns of 29%, 29% per year, for 13 consecutive years. He turned every $1,000 invested into roughly $28,000. This was the gold standard case for active management, a brilliant stock picker doing genuine fundamental research, beating the market by an enormous margin. By the late 1990s, Magellan was the world's largest mutual fund. Lynch retired at the top in 1990, itself a masterclass in knowing when to walk away. The lesson: occasionally, active management does work when you find a genuinely exceptional manager and they're early in their career. The problem is identifying them in advance. Lynch wasn't obviously special when he started, he was special in hindsight.
Now the failures.
Same structures, very different outcomes. Failure story 1. ARK Innovation, ARKK, the largest active ETF loss in history. In 2020, Cathie Wood became a star. Her actively managed ETF, ARK Innovation, ticker ARKK, returned nearly 150% in a single year. She was on every financial news channel. The fund grew to $22.9 billion in assets. Retail investors poured in. The story was that she'd identified the future: AI, gene editing, electric vehicles, fintech, and she'd ride those themes to massive returns. Then 2021 arrived. ARKK dropped 24%. Then 2022 came. ARKK dropped another 67%. Over the 2-year peak-to-trough collapse, holders lost roughly 75% of their money. Bloomberg analysts later calculated that ARKK destroyed around $13 billion of investor capital, the largest loss ever recorded by an actively managed ETF. What went wrong? Concentration. Concentration in unprofitable, high-multiple growth stocks. When interest rates rose, those stocks collapsed disproportionately. The fund's structure as an ETF didn't protect it because the contents were the problem, not the wrapper. What's fascinating, ARKK has actually recovered significantly since. By 2025 and 2026, it had posted gains again. But most investors who bought at the top in early 2021 are still underwater. The lesson isn't that ARKK is bad, it's that concentrated active bets carry asymmetric risk. The wrapper says ETF. The experience felt like a single stock bet. Failure story 2. Woodford Equity Income Fund, the unit trust catastrophe. Neil Woodford was, for 2 decades, the UK's most celebrated fund manager. He famously avoided the dot-com bubble. He profited from the 2008 financial crisis. By 2014, when he left Invesco to launch his own firm, Woodford Investment Management, he was treated as British investing royalty. His flagship fund, the Woodford Equity Income Fund, grew to over £10 billion in assets. 300,000 UK retail investors trusted him with their money. Then came the structural failure. Woodford had quietly drifted from his successful playbook of dividend-paying large caps into illiquid, unlisted small biotech companies. When his fund's performance slipped and investors started to withdraw money, he couldn't sell the illiquid holdings fast enough to meet redemptions. In June 2019, the fund was suspended. 300,000 investors were locked in. They couldn't get their money out. The fund was eventually wound down, and investors lost a substantial portion of their capital. In August 2025, the UK's Financial Conduct Authority fined Woodford £5.8 million personally, fined his firm £40 million, and banned him from managing retail funds. The lesson? A unit trust's professional management doesn't protect you from a manager drifting from their proven strategy. And unit trusts have a hidden danger ETFs largely don't: the liquidity mismatch. If a unit trust holds illiquid assets but offers daily redemption, a panic creates a death spiral. Look at those two failures side by side. ARKK was an ETF. It dropped 75%, but holders could always sell. The market price was always live. They could see what was happening in real time. They could exit any day they chose at the prevailing price. The damage was severe, but the structure worked. Woodford was a unit trust. Holders could not sell. The fund was suspended. 300,000 people were trapped while the value bled away. The structure failed at the worst possible moment. This is the single most important practical difference between the two wrappers. In a crisis, an ETF gives you liquidity. A unit trust may not. The flip side, ARKK's transparency encouraged panic selling. Watching your fund drop 5% in a single hour is psychologically brutal. Some unit trust investors, blissfully unaware of intraday volatility, hold through downturns simply because they don't see them happening. That's not a feature, but it's a real psychological effect. Neither structure is universally better. They have different failure modes. Here's how I'd think about it. Use ETFs when you want low fees, you want transparency, you want flexibility to trade during the day. You're confident enough to choose your own funds without needing an advisor. You believe, based on the data, that passive index investing beats most active managers over long periods. You're building a long-term portfolio and you want to keep more of your returns by minimizing costs. Consider unit trusts when you're investing through CPF or SRS in Singapore, or a similar tax advantage scheme that only offers unit trusts. You want exposure to a specific niche where genuinely skilled active management may add value. Certain emerging markets, certain alternative strategies. You value the relationship with a financial advisor who can help you stay disciplined. My personal bias, which I'll be transparent about, for most beginner and intermediate investors, low-cost broad market ETFs are the default. Unit trusts can complement them, but the burden of proof is on the unit trust to justify its higher fees with consistently better net returns. Most don't, but this is your decision, not mine. The honest answer is, both wrappers can serve you well or poorly. Focus more on what's inside than what it's called. 2 stories at the start of this video: Peter Lynch and Magellan, Neil Woodford and the Equity Income Fund. Same structure, the unit trust. Wildly different outcomes. That's the punchline. The wrapper isn't the investment. The wrapper is just the legal container. What matters is what's inside, who's making the decisions, what they charge, and whether you can get out when you need to. ETFs gave the world cheap, transparent, liquid market access, and that's a genuinely wonderful innovation that has made millions of ordinary investors meaningfully wealthier. Unit trusts gave the world professional management at scale, and when that management is exceptional, the results can be extraordinary. When it isn't, the costs and the lockup features can be devastating. Know what you're buying. Read the prospectus. Check the fees. Check the holdings. Don't trust marketing, trust the structure. If this was useful, subscribe. I make data-driven investing content for people who'd rather understand the machinery than chase tips. There's also a video I made on how to invest in AI stocks specifically. Link in the description. This isn't financial advice. Do your own research. But please, before you give anyone your money to manage, ask exactly what you're paying for and how easily you can get out.